Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand, evidence-based holistic insights to help you master the game of building wealth. Okay, so let's get into the first question today, and it's from Josh. Josh writes, thank you so much for your valuable insights over the past years. I have a question regarding property investing. In fact, Josh has three questions. First one, what do you do when the 5-year interest-only term finishes? Do you refinance to another 5-year interest-only term? Number two, when do we start paying down investment loan debt? Number three, do we ideally carry investment debt into retirement to maximize deductibility? Also, can you please explain the various exit strategies for property investors? So, Josh, all really good questions. And, I knew I wrote something about this, but I can't believe it was back in 2019. What is that, 6 years ago now? Boy, time flies. But I published an episode on the 7th of August 2019. Didn't have episode numbers at that point in time. And it's titled, How Are You Going to Repay All Your Loans Before You Retire? In fact, if you just Google Pro Solution, how are you going to repay all your loans before you retire? You'll find the blog. It'll take you directly to the blog. That's probably the easiest way to find it. And I think I've written another one last year was about, what's the priority? Is it debt reduction or is it investing? So I think just jump on the website. I've written a lot about these sorts of situations. And just to sort of sum it up, you would typically have an interest-only investment loan for the length of owning a particular property. Sometimes we go to principal interest. If I think about my situation, I've got one loan, so maybe about 20% of my investment debt. I don't have a home loan, thankfully, but investment debt on principal and interest. So that's probably okay as you get closer to the end of your journey, not closer to the start of it. But debt reduction typically isn't a priority necessarily. If you are investing in property and you're, say, 20 years away from retirement, the chances are that you don't need to repay much of your loan. As long as your property portfolio is neutral by the time you get to retirement, that's fine. Some level of debt, not because of the tax deductibility of it, but mainly just because the allocation of your own capital, some level of debt is worthwhile, but typically you're into retirement, you want a conservative level of debt, probably somewhere between 30 to 40% LVR, loan to value ratio, or less than that. So pretty low gearing, but zero is probably a little bit too conservative. If you are closer to 20 years to retirement, so I guess if you're older than 40 today, if you plan to retire at age 60, then you might need to start repaying some debt. And when I say repaying, what I'm really talking about is having interest-only loan and putting that cash in offset. Because you put the cash in offset, you're increasing the liquidity and access to liquid assets. And that gives you a lot more flexibility in the future as opposed to actually making principal repayments, I guess, against the loan. But have a look at the episode that I just referenced back in 2019. And again, there's a lot written about debt strategies and those sorts of things. I've covered those topics previously, and you'll find the answers on the website. But it really does depend on your age and sort of stage of life, if you like. In terms of exit strategies, I was a guest on a podcast. The podcast is called Perth Property Insider Podcast by Jared Mahone, who's actually a client of mine. And he interviewed me on the 5th of March. And the title of that episode is Don't Wait Until It's Too Late, Strategic Retirement Planning for Property Investors. Anyway, in that podcast, we talked about, some of the things that property investors need to think about leading into retirement. And so, you might want to sort of check that out. I'll say it again. It's Perth Property Insiders Podcast. 5th of May is the episode. And in fact, we will try and include a link to the podcast in the show notes today. Maybe I should have converted that episode into an episode for my podcast anyway. I hope that helps. And thanks so much, Josh, and good luck with it all. Okay, so next question is from John. John writes, thank you for producing a high-quality personal finance podcast. I'm a regular listener and truly appreciate your general advice. You're very welcome, John. I'm glad you enjoy it, and I'm glad I get a lot of really great feedback. So I appreciate you. I appreciate everyone taking the time to share that. John writes, I'd like to get your perspective on the best entity structure for my future investments. Here's a brief overview of my situation. He's 43 and his wife's 38, two kids, 11 and 13. He operates as a sole trader, obviously self-employed, in the highest income bracket. Don't really know what he does as being self-employed. Wife recently left her job and doesn't plan to return until our children are at university age. Assets, they own their own home, valued at 3.5 million with a 60% loan to value ratio. So pretty high non-tax deductible debt there. And hold internationally diversified low-cost ETF portfolio valued at 1.2 million. Both assets are in our joint names. In terms of the business structure, he recently purchased an established business. Following our accountant's advice, we set up a family trust that holds the shares in the trading company to operate that business. Moving forward, roughly 50% of his income will come from the business and 50% from sole trading activities. And so John's questions are, for investing in ETFs, should that be done in joint names or through the family trust, or set up a corporate trustee under the family trust? I think John really means their corporate beneficiary, which is just a company that's a beneficiary of the family trust. Second question is, should we maintain our current ETF portfolio outside the family trust, or would it be beneficial to sell it, bearing in mind the CGT implications, to transfer it into the family trust? How should we evaluate if this move is worthwhile? So all good questions there, John. I sort of go back to your comment, own your own home, 3.5 million with a 60% loan to value ratio. I wonder if that debt is all related to your home loan or whether you've actually used some borrowings to build the ETF portfolio. Does it change my position? Yeah, maybe. But anyway, that's the sort of question. So where should you invest moving forward? Well, if you've got business income coming out of the family trust, you could obviously distribute to individuals, being yourself and your wife and so forth. We would typically only distribute, up to $190,000 or more if it's needed. So I guess that comes back to my question about, the home loan and whether there's any non-tax deductible debt. If there is, then you really probably want to repay that as fast as possible. And so we would probably distribute more to the individuals there. You can still do that and sort of keep your average tax rate around about sort of 30%, which isn't too bad, I don't think, given that situation. But if you're making additional investments, if it's coming from after-tax dollars, so you've already made the distributions and so forth, then I do it in the family trust. If you're using taxable income to invest, then I would establish a corporate trustee probably and distribute into the company. And you will pay a 30%, well, actually, the business income's coming out into the company. You should only pay a 25% tax rate as a result of that, because it'll be considered business income into the company, which is pretty low. But the benefit is that you always get a credit for that tax. So the company's got imputation credits. So in the future, if you want to pay out a dividend from that company, then you're able to do so. So when you set up the corporate beneficiary, make sure the shares in that company are owned by your family trust. Sometimes we see some mistakes where the shares are owned personally, for instance, which is not the right structure, because if you eventually come to pay a dividend out of that company, you want the dividend to go back into the family trust so you have discretion on where to put that income or who to give that income to, as opposed to you don't want to be owning shares in personal names, the shares in the company, of course. So they're the things that I'd be thinking about. And in your situation, you already said you're a sole trader, you're already going to kind of max out your income from that point of view. Then you would probably distribute to your wife. Your kids are minors, so they're only going to receive a very small amount. And anything left over probably should go into the corporate beneficiary. That's the way I'd be thinking about that. In regards to your second question, is it worthwhile moving the existing portfolio? It's a really good question. Something we've got to tackle on a regular basis, because hopefully it's not too much of a surprise when a client comes to us, a new client comes to us and they've got pre-existing investments. Almost always there's something wrong that needs to be fixed up. And, the investment structure is sort of one of those things. And it really does depend on the capital gains tax. It depends on the quality of the underlying investments and depends on the strategy. So that would be my answer, is it depends. I think what we would do is, if they were great investments and that they had a lot of unrealized capital gains, we probably would live with the existing structure. If there's some investments there that we wouldn't otherwise make again, then we will strategically divest of them, which doesn't mean necessarily sell them tomorrow, but sell them over the next 2 or 3 years, depending on market conditions. And then gradually move some of that wealth out of your joint names, into the family trust or into the corporate beneficiary, probably into the family trust, given those assets are kind of already after tax assets. And that tends to be the approach that we take. Like, if I looked at most of our clients, we would gradually probably move a portfolio over time. And it depends on, actually, you told me your age there, John. You said 43. So probably some way from retirement, in which case then, that's a bit of a challenge, because sometimes we will leave a portfolio in its place if, retirement's, within the next 10 years, we could potentially minimize any capital gains tax. Anyway, they're the sorts of things I'd be thinking about. But I guess it goes, John, I guess it's a good example of getting it right at the start. And, it's not always possible, but good on you in terms of, it sounds like you've got yourself in a really good position, both from an income and asset perspective. So, I'm not trying to sell it as a negative outcome. Okay, next question is from Natalie. Natalie writes, my husband and I are considering setting up an education bond for our two children aged 2 and 4 with the intent to pay for private school fees. They will go to public primary school. I have two questions. I understand the tax benefits that apply after 10 years. However, I'm curious to know if the fees are significantly higher compared to setting up a normal share portfolio and investing regularly. If we agree to proceed with the education bond provider, would you advise setting up one bond per child or one account for both? What are some of the considerations we need to take into account? Okay, good questions, Natalie. I would refer you to episode 291, which I published back in February 24, so February last year. I talked about investment bonds and are they worthwhile and so forth. In terms of admin fees, it's about 0.6%. That's the additional cost you will pay to kind of access that structure. Do I think they're worthwhile? Not really. Yeah, the tax benefits in terms of investing regularly over a 10-year period, and at the end of that 10 years, you get to not pay any tax on any unrealized capital gains. But the realized gains will be taxed at 30%. So it depends on what you and your spouse's tax position is and whether that is, whether you can achieve an average rate lower than that on the income between now and then. And then it depends on the underlying investment of the total return, how much will be income and then how much will be capital gains. The other thing too is the nil capital gains tax after 10 years on unrealized gains sounds attractive on the face of it, but that's if you're going to invest for the next 10 years and then sell the entire investment in one tax year. I mean, that might happen for some people, but typically it doesn't. And if you're investing for school fees, it won't. You'll be selling over, depending on how old your children, 2 years, so you'll be selling over an 8-year period, given that there's a 2-year age gap between the kids. So you need to then think about, is the capital gains tax going to be that significant? And am I going to pay, higher fees, 0.6, and get locked into this product and continuing, because if you've got a rule that if you make regular contributions, you've got to continue to make those regular contributions. So do you really want to do that? Versus, what about your home loan? Like, if you park money in your home loan, your return's going to be, let's say, 6% after tax, and it's risk-free return. That's a pretty good place to, I think, over the next period of time, next 10 plus years, store money to use for private school fees. Probably better than an investment bond. So I don't really like them. As I said, refer to that episode 291. It was the beginning of last year. And I'll talk about it in a little bit more detail. And we have never recommended investment bonds. Other planners I talk to typically don't recommend them for the same reasons as well. They seem attractive on the face of it, but I think in the long run, there's better strategies that you can utilize that aren't going to give rise to too much tax. But great question, Natalie, and thanks for asking. I'm sure a lot of people have thought about it, particularly people with kids, of course. Okay, next question is from Luca. Kind of an interesting one. He's talking about, in fact, I'll read some of it and then paraphrase the rest. So Luca writes, I recently read your article around apartments being undervalued. You mentioned that you got to this conclusion by applying the increased cost of land per square metre to the apartments. One thing that's not clear to me then has been sparking my interest for a while. How can we apply the cost of green title land to its underlying unit land? So just to paraphrase the rest of it, and I'm not really sure around the term green title, I've never heard that before, but I think what Luke is sort of saying is that part of my thesis around units being undervalued is that if they haven't grown in value, the implication is that the land isn't worth any more than it was, say, 10 years ago. But what I'm arguing is I can cite situations where houses have sold, for instance, 10 years ago versus today, that definitely confirm that land value has changed. So therefore, my conclusion is, of course, that apartment, its intrinsic value must have changed over the last 10 years. So I'm not hanging my hat on just this one fact, but just pointing to, the difference between apartments and houses, particularly in blue chip suburbs in Melbourne, for instance. It was the case in Brisbane as well for a long time, although the last couple of years, apartments have started to really kick off. And Sydney hasn't had as great a disparity in growth between houses and apartments. Sydney apartments tend to do pretty well despite or maybe because of the planning restrictions going on in Sydney. Anyway, getting back to Luca's question, the rest of his questions are saying, well, how can you compare these two? Because if you own one apartment, one, say, out of 8 apartments that sit on a very valuable block of land, that's great, but you can't really utilize that land because you're only one of 8 owners and the dwelling is there and what's the big deal? Compared to, say, if I owned a house on a large block of land, I've got full control over that. And so what I think Luke is asking is, can we really impute the same growth? And the answer, Luca, is no. Of course not. I think the two are very different assets. Unless you can go and buy a whole block of apartments, which I think make a good investment, something that my wife and I have done, because then you can control the whole land. But so no, that's of course the growth rate on the land will be lower because that lack of control. As a 1/8 owner of or control over a body corporate, I can't compel the other 7 owners to do exactly what I want them to do with that land. So, of course not. But it still will benefit from improved land value. Because if we think about it, why is land increasing? Well, because supply is less than demand. Demand is outstripping supply. And that's probably because of locality, amenities in the area, all these sorts of things that give rise to greater supply. Also, as houses become more and more expensive, they become less and less affordable to more and more people. And of course, then people are pushed down into villa units and they need to make compromises or into apartments. And so the demand for that particular location is still strong. It's just really then an affordability factor. And given the choice, most people would probably prefer to buy a house. I mean, there's a bunch of people that like apartments and like the security and low maintenance of an apartment. But just generally speaking, most people prefer a house. But it really then comes down to affordability. So, look, hopefully that answers your question. I'm not really hanging my hat on the fact that, hey, look at this house sold down the street and I can impute a significant per square meter value on the land. And therefore, I think we should apply the same per square meter value on my apartment, my 1-bedroom apartment that I own 1 of 8 in. No, that's not true, but I'm just pointing to it has changed over the last 10 years. It must have changed, but the value of my apartment hasn't changed. And therefore, there's something a little off here, and intrinsic value is better than what the market value is. Higher than, I think I should have said. Okay, next question is from John, and I'm going to have to paraphrase this as well because it's really long, but hopefully give you enough information so people that in a similar situation to John can sort of benefit from my review as well. So John's 52 and his wife's 36. So that's relatively important, knowing that John will get access to super in 8 years, where his wife's a fair way off that. Wife works, earning 65,000. John doesn't work anymore, sold his insurance business and just spending more time with family. They have a home worth about 2.3 with about a little over $500,000 of debt, but this is fully offset with cash savings, so really no home loan debt. Investment property in Newcastle, relatively 640,000 with some debt, 590. So there's not a lot of equity in the investment property. Then in terms of cash and ETFs, mostly probably from the sale of the insurance business, it's about $2.2 million. And then about $1.5 million in a self-managed super fund. So property plus Equip Super, which is an industry fund, and some cash. Wife has about 60,000 in Host Plus. They've also got a farm that they own in a discretionary trust that generates some income, but it's starting to become more difficult to run, and they're sort of wondering what to do with that. Anyway, John went to his accountant, got some advice, and it seems like from an MLC aligned advisor. And the advice was to make some more non-concessional contributions into super, to make some concessional contributions into super, to combine the super all into a self-managed super fund and invest in some MLC index products and so forth, and open a super fund for their children and make contributions into that. And I think that's pretty much sort of sums it up. But John's really wondering what to do with his farming business, which was his passion. And what do I think about the advice? I think the advice, well, let me talk about the farming business straight away. The thing with the primary production business is that you have to quarantine primary production income. So if it makes a loss, it's not really going to help you from a taxation perspective. And rural land, as John says in his question, the values come off a little bit, but it's really had a pretty strong run over the last 10 years. So, well, given, and I think it's about 12% per annum, if you look at, I mean, that's a very general figure, of course, across Australia in terms of the increase in rural land over the last decade. And so different areas are going to perform differently, of course, but as a general observation, it's performed pretty well. So I think from a financial perspective, if it's becoming difficult to manage, then you probably move that asset on, because it does create a bit of complexity, both from a financial and a taxation perspective. In regards to the advice, you just want to be careful. It used to be that you wouldn't want to go to a bank financial planner because they've only got certain products that they could sell. And that's true with MLC. It's institutionally owned business, and you're not going to necessarily get the broad-based advice that you might get from an independent business. Now, Pro Solution is an independent business, and I like that because, I can consider and recommend any product. There's no restrictions on my license to do that. And because I own the Australian Financial Services license, I don't impose any restrictions on myself. Whereas MLC will impose restrictions on their advisor. They won't be able to talk about property. They've only got certain products that they can kind of sell you, an MLC wrap, sort of pre-mixed index style product, these sorts of things. They're not the sorts of products that I use. They're probably not the sorts of products that I'd ever use. So that's a bit of a warning for John and all the other Johns out there, in terms of just really think about, who you're getting advice from, what sort of experience do they have, and what sort of products are they able to utilize? Why aren't they using the same ETFs that we talk about on this podcast? And in fact, John has invested in. They're good ETFs, they're good products. Why do we need to brand it up under an MLC banner and potentially add fees? I'm not saying they've become a lot more competitive, right? So anything MLC was 10 years ago was expensive and you wouldn't go anywhere near it. It has definitely become more attractive, but the thing is, if you're going to work with an advisor over the next 10, 20 years, you want to make sure there's as fewer restrictions on their advice as possible. the advice doesn't look very strategic. It looks very product-based as John's laid it out. Now, I don't want to throw stones at another advisor if I don't have all the information. So I'm not saying that, but quite often, an advisor, you want strategy first and then implementation second. A lot of advisors are good on the implementation side. Okay, here's the products. Let's do this. Let's make a couple of contributions. You want the strategy bit. Like the strategy bit that I think John needs is he wants a perpetual portfolio so he doesn't have to work again, but still is able to make sure his money is invested wisely so he doesn't need to worry about money and he can spend time with his family. It doesn't really matter how much his wife works or doesn't work, and he can look after his kids and his family long term. That's really what he wants. So what's the strategy around that? What are the ownership structures that we're going to utilize? How much are we going to put into super? How much are we going to put into property? How much into shares? Do we need to have any defensive elements? So do we need any fixed interest or bonds? Or in fact, are we just better off kind of wearing the volatility and moving forward? I think that's the strategy advice that you're really looking for and that you really need. And I'm not sure whether you've got that advice, like whether it sort of shines through at this stage, just based on what I'm told, of course. It doesn't look like it. John's asked a couple of, specific questions. Is it worth moving the farm into a self-managed super fund? I mean, you could do that if it's business real property. So we'd need to think about, the title and how it's classified. I think you're actually probably just better off moving the farm on. It sounds like you've got a bit of capital tied up in there. It's not really going to produce an income, and we're a bit uncertain about what capital growth might yield from it. And then if you overlay the fact that it adds complexity and it's not really suiting your lifestyle at this point in time, I'd be inclined, at least based on what you've said, to probably move the farm on. Next question is it worth setting up a wrap platform? Because John's been using Perla and ShareSite for monitoring and reporting and so forth. Look, if you've got a portfolio, John has a portfolio of north of $2 million. To my mind, you definitely want to be on a platform. A platform is going to give you much better comprehensive returns reporting, both on an individual holding basis and on a portfolio basis. It'll give you reporting on asset allocation, which is important. It'll give you reporting on tax cost bases, particularly by tranches, so that you're able to minimize any capital gains tax if you are selling down any holdings. And all those things, that information is critical. It's critical for me to know that information to be able to give you good advice. And so whilst you might be able to save $4,000 a year is what John said that platform might cost, that seems a bit expensive, by the way. I think platform fees normally cap out at about $3,000 a year, around about that mark, I think. So it falls a little bit on the higher side. Doesn't surprise me with MLC though. Anyway, I think it's worth, even if it did cost $4,000, it's probably still worthwhile. You want to run this perpetual portfolio. It's really about making sure you've got the right information to make good quality decisions. And the final observation that John shares is that he thinks that his wife and he has more of a growth profile, whereas the recommendations he's been given have been more balanced. So I guess what that sort of says is it's including fixed interest and defensive investments. And look, the whole thing about running a perpetual portfolio is that, if you're spending 5% of your balance each year, but on average you're earning 7%, the capital balance of your portfolio is going to be okay. It's going to continue to increase. If we allowed, say, 2% for inflation, there's no real change in the value of that portfolio, which means it's a perpetual portfolio. You could mathematically live forever. To try and achieve a return of 7% plus on average over the long term, you need to be well invested, I think. And my view with something like that is that if the client is comfortable, we should be willing to just enjoy. I use the word enjoy facetiously, but enjoy the volatility that markets will provide on the basis that our goal is to maximize decade-long returns, so longer-term returns. And that would say to me then, in situations like John has, particularly if he's got cash in offset account, maybe I'd put some cash in the investment property loan just to increase liquidity in return for then taking higher risk in his portfolios, which means having a greater allocation towards shares. And whilst, yes, that might create more volatility, as we've seen over the course of this year, then the reality is, or in fact, put correctly, the overwhelming evidence is over a 10-year period, it will generate better returns. And that's what the history has told us. So I kind of agree with you, John, particularly given, your wife is a little younger than you. You probably should take more of a growth approach. And I don't know if I'd have a lot of defensive investments in that portfolio, assuming that you were comfortable, and you say you are comfortable with that sort of volatility. I should say, I'll just add a comment here. Hopefully it's not too out of date by the time people listening to this in a week's time. But if you have a look at the performance of the index, the share index that excludes the US market, year to date, so calendar year to date, it's returned a positive return of about 2%. If you look at the index, including the US, so the global developed market index, it's negative 8%. So it does show you that, yes, having exposure to equities does increase volatility, but it's how you're investing that makes a big difference. And I've been speaking in this podcast over the last number of years that we've been underweight US. And so if you use that comparison there, and really what I'm comparing is VEU and VGS as two ETFs. VGU does have some emerging markets in it, but it's ex-US, excludes US. And VGS is just the general MSCI World Index, which includes the US, about 70+% into the US. But it shows, that you can still have investments in shares, if you like. It's how you use the indexes and how you construct those indexes that will demonstrate different performance and different portfolio risks. Anyway, a very long-winded answer there for John, but sometimes I like to go down these rabbit holes to some extent so that everyone can kind of benefit, because we all need to think about these things at some stage in our life in terms of, how is our portfolio structured? Who are we getting advice from? All those sorts of things. Okay, I'll leave it there. Tomorrow, I've got, I think, a really good subject to share with you. I really talk about, what to do if you're not ready for financial advice yet. So if it's not worth you paying $5,000 a year to a financial advisor ongoing, then what road should you take? It's a common question we get not only in the podcast, but day to day. And so hopefully you can tune in for that. Cheers. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.